thing, our purpose, has always been to generate really attractive compound rate of return for our clients. And so we've never really seen any need to launch lots of different funds and flavors and growth and value and long and short and small cap and large cap or whatever, different geographies or different approaches. It's not to say that that doesn't work for other businesses, but ultimately what we've been very, very focused on from the start is trying to deliver this great compound rate of return through, a single fund, and just keeping it simple, it helps focus the mind.
Hi there, folks. I'm really delighted to welcome our guest today, Anthony Kingsley, who's joining us from his office in London, the city where I grew up. Anthony is the Chief Investment Officer at a firm called Findlay Park, where he oversees more than $10 billion. And he's the portfolio manager of the Findlay Park American Fund, which has achieved the very rare feat of crushing the market over the last quarter of a century. It's lovely to see you, Anthony. Thanks a lot for joining us.
Great to be here.
So one of the things that I wanted to talk about in some depth is just how the Findlay Park American Fund, which is the one fund in your company, how it's racked up this extraordinary return of more than 12% a year over 25 years, which has beaten the Russell 1000, the index that you're benchmarked against, by an absolute mile. I think the Russell 1000 averaged about 7.2% a year. So when I last checked, basically you'd beaten the index by a cumulative total of 1,200 percentage points. So it's a remarkable success story. And I want to get a sense from you of what we can learn from your fund's achievement about how to build wealth in a sustainable way. So I figure it probably makes sense to start at the beginning with the founding partners of the fund, James Findlay and Charlie Park, who launched the fund back in 1998. What can you tell us about them?
Yes, well, I worked with James Findlay in the early 90s. That was my first job as a graduate trainee in a fund management company, Foreign and Colonial, and they specialized in investment trusts. Frankly, I knew nothing about investing, but it was a great place to learn. And I was put on the American desk as a graduate, and James was sort of making his way in US smaller companies. He had an investment trust and he had an open-ended fund. And frankly, he was sort of the first mentor I probably ever had in life. And he's probably been the most important mentor that I've ever had. And he just taught me so much in those early years about investing, about managing downside risk, about trying to produce a good compound rate of return, the importance of compounding, the eighth wonder of the world. And so, I knew James pretty well. I wasn't one of the founders of Findlay Park, but I'd gone off to do something slightly different in fund management. But we kept in touch. And he said, for 4 years into the business in 2002, he said, "Would you like to come and join?" And I mentioned, his importance as a mentor to me. And I think I always thought, if I don't join, if I don't come, I might spend the rest of my life, regretting that decision. And so, I joined as the third partner and the fourth employee in the early 2000s. And James and Charlie had both independently developed a really good track record of investing in US smaller companies. And so, I joined the team and off I went.
And my sense is that one of the formative experiences for James was that he'd been this hotshot manager at Foreign and Colonial, and it had been kind of a great period for someone who specialized in US small cap stocks. And then I guess the market famously crashed in 1987 when I think I'm right in saying that Black Monday, which I think was October 19th, 1987, was the biggest one-day market drop in US history. This is coming right after a torrid period where the market had gone up something like 44% earlier in the year. And so my sense is that James was sort of this hotshot young fund manager when you first knew him, who then got absolutely clobbered. And I'm wondering if you have a memory of how that experience changed the game for him.
Yeah, so he had a rough experience in the late 80s, as I say, the 87 stock market crash, and I think sort of decided at that stage to read all the investment books he could and come up with a new philosophy, which was really more about managing downside risk. And so that by the time I joined F&C in the early 90s, he was already well on his way to building a new track record in US smaller companies using this philosophy. So, but certainly that experience was a pretty seminal one for him. At that stage, he, as a mentor to me, he told me to go and read all these books, and whether it was William O'Neill or Reminiscence of a Stock Operator, or the Berkshire Hathaway the biographies have been written on Buffett or Munger. And so, I sort of voraciously consumed these things. And he put together a 7 or 8 page investment philosophy, which was really around the learnings from the 87 stock market correction and how to apply a new philosophy, which I say at the heart of it was around managing downside risk.
So it seems to me there are several things that are really central to your approach that help to account for the success of Findlay Park over the last quarter of a century, and hopefully we'll go through them in some detail in order. So as I see it, this issue of managing downside risk is critical. I'd love to talk about simplicity is really key. The use of an investment philosophy checklist and the focus on high quality businesses and the like. So we can go through these and other things in various orders, but I think I'd like to start by talking about this idea of simplicity, which was a major theme in my book, because I feel like in a very complex world where we're all so confused and there's such a barrage of information and there's so many different approaches and possible lures and temptations to go astray, it's an incredible competitive advantage actually to be able to distill things and have a few fairly simple guiding principles and a fairly simple approach. And one thing that's distinctive about Findlay Park is that you have this philosophy, a guiding principle of keeping it simple. So I wondered if you could talk about simplicity as it relates to Findlay, how it manifests in really everything that you're doing.
Yeah, absolutely. So keep it simple was an important philosophy of James. And I think a really probably underestimated, mantra. Simplicity. If you look at Findlay Park today as a business, it's quite unusual, because after 25 years of investing in America and American companies, we just have one fund. We have one strategy, one investment philosophy. We have one team here based in London. And we have, a focused group of clients many of whom have been with us since the start. That's quite unusual. Normally, when fund management companies get a bit of success, I've certainly found is they sort of say, well, what else can we do? What other strategies can we launch? And they diversify. They try and asset gather. They're in the asset gathering business. Our focus from the beginning, our purpose has always been to generate really attractive compound rate of return for our clients. And so we've never really seen any need to, launch lots of different funds and flavors and growth and value and long and short and small cap and large cap or whatever, different geographies or different approaches. It's not to say that doesn't work for, other businesses. But ultimately what we've been very, very focused on from the start is trying to deliver this great compound rate of return through, a single fund, and just keeping it simple. It helps focus the mind. I mean, we're very aligned with our clients. We've got one fund, and we better do pretty well, because we've got other funds to fall back on if that one doesn't do well. We're all very aligned with our clients, and it helps focus the mind on what not to do often as much as what one should do.
I think I'm also right in saying you once told me that you just have one fee as well, like that there are no fee breaks for anyone who comes along, that even the partners in the fund, like yourself, pay the same fee. Why is that important?
Well, I think keeping it simple just has a lot of advantages. If you have different fee structures for different clients, you sort of forget, what did you give that client, or what did you give that client? The next one comes along, and you end up spending, hours and hours negotiating on fees, and um, your head starts spinning. Asset gathering hasn't been key to our business. We thought if we can deliver a really good rate of compound performance, hopefully we can have a fee that's competitive enough that people will feel that they're getting value in terms of the return that we're able to deliver. So yeah, we've just got one fund, no separate accounts, one fee structure. We all think, well, if our clients are paying that fee, why shouldn't we pay the same fee? And so when we quote in our newsletter or in our reports the performance of the fund, 12% compound for 25 years, that is a net of fees number. And the reason we can quote that, unlike maybe some other asset management firms, is we only have one fee. Whereas, they have to quote it gross because they've got a lot of different fee structures for different clients. So it's part of that, just keeping it simple. And you can then focus on what you do best. In our case, we think, investing.
There's also a really nice alignment of interests there, I think, with the fact that you're not the most favored nation, giving yourselves a much better deal than your clients. I think that's a really nice thing. And I was very struck. I think one of the first times we met and talked was when I came to your 25th anniversary celebration to be a speaker there. And I remember you introduced me to James Findlay there, who was a surprisingly kind of quiet, modest, charming guy, like very humble. And I remember you saying to me that one thing he had told you when you were taking over the firm, if I'm quoting this correctly, he just said to you, treat the shareholders right, treat them fairly. Is that fair to say that was always kind of an emphasis?
Oh, definitely. I mean, James taught me so much. We could be here for hours just discussing all the things that I've learned from him. And one thing I will say is he's a very sort of humble, low-key guy. But in my opinion, and I've come across many great investors, one of the greatest investors I've ever come across, who has a very, very low profile, but extraordinarily successful, and a super guy, in terms of kind of morals, I'd say AAA character, who, taught me early on that, the good news can wait, but if you've got bad news, you must share that with the client. You must always be honest and open with the client and share, if you made a change in the portfolio or something's not going right. I mean, it's so much so that in those newsletters in the early years, certainly he used to sort of, almost sort of negatively market the fund in the newsletters. So, we're not quite sure how well we're going to do. And so, if you want a bit of technology, you would probably go and find a technology fund, or, you shouldn't have all your money, American money in this fund. And he was incredibly open and honest. And that stuck with me. It's been kind of a powerful force in my life, actually.
Yeah, the newsletter that you're referring to, which is unusual, is this 15 to 20 page quarterly newsletter that the firm sends out, which is very rich and full of advice. So I think that's another thing, actually, just the clarity of the communication. You know what you're getting, and it's what it says on the tin. And so you were mentioning that he's one of the most extraordinary investors you've met, and I know that a lot of the people I wrote about in my book, whether it's the Howard Markses or the Bill Millers or the Nick Sleep and Case the Curriers. When you look at James, who's not well known, who's kept a really low profile, although obviously he's had huge success, what in terms of his temperament and personality stands out? What makes you actually look at him and think, oh, that's what a great investor needs to be wired like? Those are the personality traits of a great investor.
Yeah. So, I mean, he's very level-headed. To use a sort of Charlie Munger word, he's very rational. He's just got a very, very good temperament. When things are going really well, he's not, strong on self-congratulation, but equally when things are going badly, often, the truth is when the stock market is penalizing something, it's not quite as bad as it may seem when you look at the share price. And so I think he's got a good temperament. He's rational. He focuses on the fundamentals. He's a fundamental, bottom up stock picker. And so I think those would be some of the things in terms of temperaments that give him an advantage, perhaps, than versus some others.
I think another thing that's been striking in terms of the simplicity of the firm over the years is that it was never that marketing oriented. I mean, I think you told me at one point that it had basically been soft closed for something like 20 years, that you had about 50 institutional clients in the UK and Europe, and that was about it. And so people couldn't invest directly. They had to go through a wealth manager. So there was also something about the quietness of what you were doing, that you were just going about this very clear and focused task of trying to deliver compelling returns over decades for clients. Is that fair to say that it wasn't? I mean, there is something a bit like Nick and Zach at Nomad, that it was all focused on the returns and not really on building scale, building your reputations and the like.
Very much so. I mean, James and I know Nick and Zach well, and what they were doing in those early years, and we used to have some good conversations. And in many ways, it was similar. I mean, one of the reasons we talked about the newsletter, one of the reasons that James wrote that newsletter was, he was the marketing department, and it was a great way to, while James and Charlie invested in stocks, to stay focused on investing in stocks, visiting companies, going to America, meeting the managements, and just keeping up, the investors up to date. And we always sort of said in those days, we said, we'll send the newsletter out, but if investors want to see us, give us a call. We'll come and see you. Many of our clients are here in the UK, just easy to access them. But many of them were quite happy with the newsletter. So it was really a focus, as I said, to produce a really attractive compound rate of return by investing in a diversified portfolio in America. And, compounding is just, as I said, it's like the eighth wonder of the world. As Charlie Munger says, never interrupt it unnecessarily. I mean, we've been going now for 25 years. We've compounded at 12% after fees. So that's about 17 or 18x. But really what we want to do is we want to keep that going. We want to have it. I mean, James is not here, James is on the board, but he's not running the fund. We've got a different team running the fund today. I'm involved at some stage. Hopefully in the, long time from now, there'll be another team that's running this, but we want to keep that compounding. And, if you can keep that compounding record going, as you better than most know, you can produce extraordinary results over time. I mean, if we're able to generate another 12% over the next 25 years, then you have a 300x return approximately over 2 generations, and that is, that's sort of pretty extraordinary. So I think it's always been this understanding of compounding. You've got to stay in the game. You cannot. Of course, we've had some good years, we've had some tough years, but we've never. We've never blown ourselves up. We stayed in the game on this compounding journey, and that's really been the focus from the beginning for James, Charlie, myself, is just produce a great return, and hopefully we'll have enough clients to run a successful business.
So, as you've said to me in the past, a huge amount of the success of the firm actually hinges on managing downside risk and just not doing anything too stupid so that you don't interrupt that compounding. And I want to talk in some detail about how you do that, because it seems to me that's one of the most practical lessons that our listeners can learn. Because as Charlie would say, it's really hard to be smart, but it's pretty easy not to be stupid. And that seems to me such a huge part of success in investing. And one thing that's striking is that your fund, when I last checked, basically in 31 down quarters for the market since Charlie and James founded the fund back in 1998. In 31 of those down quarters, the fund has outperformed in 29 of the 31. So it kind of has a remarkable record of not only racking up good returns, but with less risk than the market, with less risk of total implosion or disaster or permanent loss of capital, however you want to define it. Can you explain how you go about this, how in very practical terms you go about avoiding disaster?
Yeah, no, it's absolutely key. And as you pointed out, we've built the record by going down less than the benchmark that we've been measured against in most of those quarters. And what we try and do is keep up. We try and keep up in a good market, go down less in a bad market. And if you understand the power of compounding, that we're trying to avoid permanent capital loss in any individual stock. Now, you can't always get that right, but we're trying to. Our starting point is how much can we lose if we're wrong, rather than how much can we make if we're right. And I think that is probably contrary to a lot of investors. Investors look at some shiny object or stock and they go, "This looks very exciting," and they think about how much they can make if they're right. Our starting point is, obviously we want to make good returns and compound over time, but our starting point is, but if we're wrong, how much are we going to lose? And, it's understanding that if you're down a third in a stock, you've got to go up 50% just to get back to where you started. If you're down 50%, you've got to double your money. So if you can avoid that downside capture, you can produce a really good compound rate of return by, to use your words, by being consistently not stupid. There are so many opportunities to get carried away by, the latest fad or fashion or meme stock or IPO frenzy, or there's the latest, AI thing or whatever it is. Over 25 years, there's been no end to things that you could have got sucked into. So by having a investment philosophy, which you don't just pay lip service to, but you stick to, you use rigorously when selecting your companies, you can build this track record over time. And of course, over time, companies grow and they have nice tailwinds. And I think I was listening to a podcast that you did with Tom Gaynor some months ago, and he was talking about, even the person that doesn't do the luge, can still get down there. It's not like you're sort of luging uphill. You've got some nice tailwinds. So to use your phrase, by being consistently not stupid, avoiding downside risk, you can produce a really good compound rate of return over time. And that's sort of what we've done, even while making lots of mistakes.
In some way, it's interesting also, there is an element of the Tom Gaynor about your approach where it's relatively concentrated, but relatively diversified. There's a kind of middle way, a sort of tension between the desire to concentrate so that you can outperform and the diversification that enables you to survive. And so I looked at one of your most recent documents, and it seemed like you had about 42% of your assets under management in the top 15 stocks, which is relatively concentrated, but you own 59 stocks, which is relatively diversified, and sort of it makes it quite difficult in some ways to outperform compared to some of the more aggressive people I've written about who, like Nick and Zach, who would get to a point where basically have most of their money in 10 stocks. How do you think about that tension between survival and outperformance or diversification?
Yeah, no, it's a wonderful question. I think it's to some extent to do with temperament. It's not to say that Nick and Zach or some other folks who have a 10 stock portfolio aren't brilliant at it. But usually, invariably, the high low in a stock in any one year, even if the fundamentals haven't changed that much, is quite wide, and you get tested. And if you've got what we have found, certainly for Findlay Park and our temperament, if you've got too much in a position, it's difficult sometimes to add to it. Investing is you need to be on the front foot in terms of psychology. And if you're just on the back foot a little bit and you've got a bit too much of something, you go, yeah, but I got a bit too much of this, so I can't add it. If you've got a diversified portfolio with some degree of concentration, top 10, 30% plus of the fund, as you mentioned, top 15, low 40s, you're making bets, but you can also just live with that volatility and let the compounding do the work. And so, take Texas Instruments we've owned for more than a decade. I mean, it's a cyclical business in analog semiconductors. I mean, it's a growth business. Over time, the electronic content of communication devices, of industrial products, of cars, of consumer products goes up, and they sell more analog products and they gain a little share. But boy, do you have semiconductor cycles. And so, it's been an amazing stock over 10 years, but it's volatile. And for us and the Findlay Park temperament and what we're trying to deliver, we would just like to have, 60 stocks with, 2%, 3% positions, 3% plus positions. And with things that we can live with. So we can live and let the compounding of those businesses do the work without getting too stressed. We like to sleep at night, and we try and deliver a consistent, return for our clients over time. So, it's not to say that others don't do it well with 10 stocks. So it's just what's worked for us.
I think another thing that's distinctive from the approach of a lot of the people I've written about, who tend to be lone wolves making very independent decisions, or maybe there are two of them sometimes in the case of Nick and Zach, but often one in the case of someone like Monish Pabrai, or maybe two with Howard Marks and Bruce Karsh. I mean, usually smallish teams. You have a fairly large team. You have, I think, typically about 13, 14, 15 people in your investment team, and you have this system of two people covering every stock, so that there's built-in debate. Can you talk about how that team approach also protects you against stupidity, against the likelihood of being blindsided by something that you just hadn't thought about?
Absolutely. I mean, we had this co-coverage model, which is perhaps a little unusual. So when an idea is being researched or reviewed to the team, or indeed just ongoing coverage, you've always got a couple of people who are sort of experts looking at that, and that means that they can have a healthy debate about it, and you don't get individual sort of confirmation bias perhaps. But ultimately, every stock that goes into the portfolio is reviewed to the whole team, and we review existing stocks. We'll do re-reviews. We'll review new stocks, and that co-coverage team will bring them to the team. And ultimately, we're just trying to get to the right answer. We've got a culture where we trust, where ideas are. We want to hear from other people. Ideas are encouraged. I certainly don't have all the answers or ideas, and I'm very open to listening to others. No one's shouted at each other in 15 years, but equally, we do kick the tires pretty hard. We have a very open and honest conversation about what we think. I mean, ultimately, we're just trying to get to the right answer. I mean, the ultimate decision lies with me in terms of the stock going into the fund. But very often I'm in agreement with with the team and the portfolio managers recommending it, and we have a very open debate.
I thought it was interesting. I was looking through one of your documents last night, and it said that the incentive schemes for your investment team members are based on three pillars, and one of them obviously is quality of work, another is performance, and the third is collaboration. And I thought that was interesting that you can kind of talk about these grand ideas like, oh, I want you to be collaborative, but actually, if you pay people based on whether they're collaborative, it's much more likely that you'll actually get what you're incentivizing for.
Oh, it's so true. And to use another Charlie Mungerism, he always says, I've always thought the power of incentives were important, and yet I've consistently underestimated the power of incentives in my lifetime. And show me the incentive, and I'll show you the outcome. And if you just incentivize people purely on performance, you'd get a bunch of fighter pilots doing their own thing. And if you incentivize people on performance and attitude or collaboration, or how are you helping the team? How are you involved in the debate? Are you giving feedback? Are you critically appraising, an idea? Are you suggesting? It helps reinforce that culture. And ultimately, I think, in our system, it leads to better decisions.
Yeah, I think this understanding of incentives, once you actually get it, it transforms your view of so much in life. It's sort of everything, not everything, but enormous. And so I thought that was a very pragmatic move in managing your business. And it made me think, oh, it's not just talk. It's like actually it's structured that way in terms of incentives. I wanted to also ask you about, in terms of avoiding catastrophe, a laminated piece of paper that you have that you mentioned to me once when we were on the phone, that you said is titled "Avoiding Investment Mistakes." How helpful is that? I mean, what's on it? What do you do to remind yourself just not to be stupid by looking at that list of common investment mistakes?
Yeah, so we obviously we focus on this checklist of things that we're trying to find, but over the years we've produced a laminate of where we've consistently got things wrong, and just to remind ourselves. And so those can be grouped under the business, financial, management, process, valuation. I can go into sort of, it's probably about, 30 or 40 points in total. They're all sort of just reminders. I encourage everyone to just look at this laminated sheet that they have on their desks every now and then. Again, just to avoid sort of stupidity. But, a lot of it is just incredibly common sense. On management, look for management that you can trust. Look for CEOs who've got a track record in the industry. Be careful about management who are selling stock or giving aggressive guidance. Be careful about managements who are, too smooth talking. Be careful about managements who are, running the business with consistently levered balance sheets and rolling up acquisitions. Look at it, to your point about incentives. Be careful of managements whose incentives are not aligned with those of shareholders. So those would be just a handful just on the management side, and we could go into the business side or the process side. But it's just lessons over time that we have learned that help us avoid permanent capital loss.
And are there mistakes and behavioral glitches that you're particularly prone to? Because I remember talking to you about things like Markel once, and you said to me, we stupidly sold Markel. They had some short-term issue, like maybe there were a couple of bad acquisitions or there were some underwriting issues, but you're like, it was nuts. It was dumb. I should have held it. Like, are there things that you have to beware of because it's part of your own wiring?
Yeah. Well, William, thanks for reminding me about Markel again.
My pleasure.
But on valuation of this, avoiding mistakes, one of the things there that we remind ourselves on is don't sell too early when it's a fantastic business. When you've got a good business that's growing, that's got high returns on capital, where there's a high degree of inevitability of outcome, just because the stock gets a little bit expensive, sometimes those other things can justify a high valuation. And that is, that is on our avoiding mistakes. And I can tell you, our return would have been meaningfully higher than 12% compound if we'd paid more attention to that. We're quite, what I'd say Findlay Park are quite good at, have been quite good at over time, is identifying good companies that meet the checklist. What we've not been so good at always is execution, which means that sometimes we've just sold stocks. We've been quite pleased with ourselves. We made 3 times our money, but they've gone on to be 10 baggers or 15 baggers, and you just think, my gosh, that was really dumb.
So I think a really distinctive aspect of your process is that it's built around this other laminated thing, which is your investment philosophy checklist. And if I'm right in thinking, you basically took what James Findlay had done early on in terms of writing down 7 or 8 pages of his beliefs about what works in markets, and you then turned it into an investment philosophy checklist. Can you talk about how you went about that process and how it benefits you and how it was influenced by Atul Gawande or whoever in figuring out the importance of having this type of very tangible, written down, written in stone philosophy checklist?
Yeah, absolutely. So I've been working with James for 20 years in sort of 2015 on and off, but since the start of my career, as I mentioned, and then rejoined Findlay Park in 2002. And we'd always looked at this document on the website, which was James's investment philosophy from the 1987 experience, and it was pretty timeless document. But I think the thing when I became CIO, he handed over to me in sort of 2015, 16 and said, the kid's grown up, let the kid have a go. And so we were sort of joint CIO for a while, and then he sort of handed it to me. And I said, well, look, it's great to have this investment philosophy, but but how do we know we're implementing it? And I didn't feel in all cases, all the time, we were implementing it. And especially as you bring new people in. I'd read this Atul Gawande book, the Checklist Manifesto, I think at around that time or maybe a few years before. And, the idea that a pilot has a checklist and before they take off, they run through the checklist, even though they know what to do, they run through the checklist. A surgeon in an operating room, has a checklist, even though they know what to do, you run through a checklist, and fund managers tend not to have that. They think they can keep everything in their head and they can remember everything in an 8-page document. And I know that I'm just not smart enough to do that. So I said to the team, why don't we try and put this document into a checklist? And so it was really a team effort. And we distilled it into 29 points. And 7 or 8 years on, we're still using it. We've tweaked it a little bit over the years and tweaked a few questions, but essentially it is the investment philosophy that's been tried and tested since the early 90s. And it's proved, it's proved its worth, I think.
It's funny. I once asked Charlie Munger, when I first spoke to him, I think, about his own use of a checklist. And he's like, no, I can just keep it all in my head. And I was like, yeah, but I don't think anyone else can do that. And
not many people are like Charlie Munger.
No.
I mean, I'm a person with very average intelligence. I simply can't remember all of these things. And so you put them down a list. But, the questions themselves are, again, they're it's common sense. More than half of them relate to the business. So a business quality and business competitive advantage. And ultimately, we're trying to get to, what is that quality? We want to invest in quality businesses that have enduring competitive advantage so that we can feel confident about the inevitability of the outcome. And then a number of the other questions are around, financials, free cash flow and leverage and management incentives and confidence in management, culture, purpose. But the big chunk of them are related to business quality and competitive advantage. We're trying to invest in high quality businesses that generate good returns, where you can just hold them and let them compound.
It was curious to me that one of the 3 big chunks of the checklist appears to be about management and asking questions like, do we like their corporate purpose and culture? And are they good capital allocators? Can you talk about this issue of focusing on the culture and purpose of companies that you invest in? Because it's a bit of a nebulous, vague thing. And yet it turns out to be hugely important, whether it's a company like Berkshire or Costco, both of which I think you own, or Amazon. And I think at one point, didn't you decide to give yourself a double score on the checklist for questions related to culture? So it's inordinately important to you.
That's right. I think when you look back and you look at certain companies and why they've been successful, it's not always the case, but often culture is something that's been underestimated. And so, companies that obviously look after shareholders are important. We're trying to make a profit here and a shareholder return. But I believe that companies that look after their employees, that have good Glassdoor scores, where you've got satisfied employees, companies that look after their customers and have a strong customer value proposition, are well placed to succeed. And so, culture and purpose. I mean, one of the things that we look at is, we don't like businesses where they have a product that customers have to have, but customers hate the company. They've got pricing power, but because the customers have got no choice of nowhere else to go. Ultimately, we don't think that leads to a very inevitable outcome. Whereas if you're like a Costco and you are permanently delighting customers, you look after employees, you pay them well, you put all these things together, you can deliver supernormal returns over time by considering, all the stakeholders and building a good culture. I think we try to do that at Findlay Park. I think it's I think one of the reasons for the success of Findlay Park is, frankly, a very focused purpose to generate great returns for our clients, and a culture of, creating an environment for employees to do their best work, to have fun, and to deliver for, to deliver for our stakeholders. So I think culture and purpose, I believe we've probably underestimated in the past. And that's why we've sort of double scored it. A few questions we double score, like culture, like pricing power, and returns without leverage. A few things that we think are kind of super factors.
So when you were trying to figure out the culture of a company, you're obviously doing a lot of due diligence and talking to divisional leaders and former employees and the like, and competitors. Are you looking for inconsistencies in what they're saying to see whether someone is saying, yeah, no, it's a lovely place to work, and then you talk to people and you're like, God, I just wish my boss wasn't such a...
Yeah, I mean, it's you build up a picture over time. You cover a company and you meet management, you meet different levels of management. Obviously, Glassdoor, and in her site, there's other ways of getting data these days on employee feedback and satisfaction, where some of the issues are. And if you're in the top, I mean, there is a correlation, in my opinion, between satisfied employees and and shareholder returns. And if you're the 500th company in the S&P 500 on the Glassdoor scores, you're probably you're going to be challenged to deliver really great returns. So there's some outside data we can use. We can interview managements. We can also use expert networks to access employees, former employees, competitors, to get a sense of that. And we're very focused on the leadership. Anytime the leadership changes, how does that, how might that impact the culture? So we build up a picture over time. We produced a list of sort of half a dozen questions that help us probe on culture. What is the culture? How is it manifested throughout the organization? How has it changed over time? Why has it changed over time? So there's a series of questions also we've developed to just help us sort of get to the bottom of it. You never really get a full picture, but you can build up a picture over time. And we've certainly given it a good go.
I was also really struck by the extent to which your documents really deal extensively with ESG. And obviously there's been an ESG backlash here in the US recently, and lots of polarization about the issue. And I guess I have some sympathy towards the view that there is a danger of greenwashing, and that Wall Street is pretty good at selling anything. And if they can sell stuff by saying that it meets their ESG criteria, they'll do it. So I do think it's appropriate to be somewhat cynical about it. But I also think these issues of environment and social good and governance are hugely important. And I think there's a sort of real danger of using that backlash and the allegations of hypocrisy to kind of dismiss this thing that's actually really important. And so I was interested to see the extent to which ESG runs through your checklist. And I think you have also a responsible investment gauge that you use that has something like 19 different factors related to climate and environment and human capital and business ethics and reputation and cybersecurity and data privacy and all of these things. Can you talk about this whole issue of ESG actually being a really important aspect of finding businesses that are sustainable and achieving long-term success? So it's a practical and pragmatic thing, and not just something that we should be debating politically.
Yeah. No. Thanks, William. I appreciate the opportunity to discuss this, because, I think the pendulum swung a long way in one direction, and now it seems to be swinging a long way in the other direction. I think we take rather a more pragmatic approach. I mean, what is ESG? It could be ESG, it could be SGE, it could be GSE. I don't know whoever chose the order of ESG, and the E seems to be getting a lot of attention at the moment. But the truth is that we believe that responsibly managed companies, are best placed to produce great compound returns for our clients. And so we do pay close attention to those factors. I mean, good governance is an important factor when we look at companies. Does it have a sensible board? Are management incentives? We talked about incentives aligned with those of shareholders. Do they make sense? Would we back management to run this company well and successfully? And so the G is that's absolutely integrated into our philosophy checklist. Equally, the S is integrated into our philosophy checklist. We want to have companies that are delivering good customer value propositions. So thinking about not just and I mentioned the Glassdoor scores. We want to have companies that ultimately are treating employees well, looking after employees, and creating an environment where they can do their best work and thrive, and they can retain and attract the best people so that they can be successful. So, thinking about, we've always thought about other stakeholders. That when you think about customers and employees, you get better results for shareholders. We talked about Costco, and there are many, many other examples. So that is integrated into our process. On the E side of things, we've got many companies that we think are providing products and services that are helping to create a more sustainable world. For example, some of our building insulation companies. We own TopBuild. We own a nice holding in that. It's one of our bigger holdings. And they, the dominant company in providing, insulation to residential and commercial houses. Well, residential houses and commercial properties. And of course, insulation actually is one of the best ways that you can reduce your carbon footprint. And so now it doesn't mean that actually TopBuild is not a high scoring company on our philosophy checklist. The starting point is it a good business? Does it fit? But it can also create opportunity. And so for me, I see ESG as a tool that is integrated into our investment process that helps us manage both opportunity and risk, manage risk, downside risk, and find opportunity. And we take a really pragmatic approach here. And hopefully we've never greenwashed here on this front. We tend not to have slides in our pack around ESG, but we just sort of get on and do it like we've always been doing it. We do have this responsible investment gauge where we look at other factors and pull in other information and data, again, to help us manage opportunity and risk.
Yeah, I was struck by that pragmatism, where on the one hand, you do still own some fossil fuel companies like EOG Resources, which I think is a low carbon producer of oil and gas, and Conoco as well. But these are companies that, as you've pointed out in the past, are going to play an important role in the energy transition. But at the same time, you also have a question, I think you added in 2021 to your checklist, where you say, is the company a net beneficiary of climate economics? So it's very pragmatic. It's saying there is a trend here in terms of the environment, and we want to align ourselves with that trend, and we want to make sure that we're not blindsided by it.
Yeah, I think that's right. I mean, we've always tried to be pragmatic. I mean, I think it is an important trend, which in my view, although the tide may be shifting a little bit in terms of the rhetoric and the fund management companies saying I'm aligned with it or I'm not aligned with it. If you look at what businesses are doing, there's clear momentum to reduce their environmental footprint and become more sustainable. I think it is an enduring trend. And so we have got a question there, one point on our 29 questions. So, but at the same time, we fully recognize that there needs to be an energy transition, and the world would simply stop functioning today if we didn't have fossil fuels. And so how do we get from A to B in a responsible way through, responsibly managed businesses? And so we've never operated a sort of divestment strategy here of saying, well, we only want to be in AAA rated ESG companies. We've taken a much more pragmatic approach. And In fact, on our RIG, our responsible investment gauge, a company like EOG actually scores quite well relative to all the sort of factors that we look at. By contrast, some of the social media companies, which get quite high ratings from third-party vendors, don't score so well. And so, everyone has their own different ways of measuring these things. But ultimately, yeah, we are pragmatic.
So things like Meta and X, formerly known as Twitter, in the same way that Glyph, formerly known as Prince, is now X, they don't score very well. These social media companies, would they be ones that don't score great?
They don't. We've tended to avoid those companies at Findlay Park. I mean, for various reasons, they don't score that highly on our investment philosophy checklist either. So, Findlay Park right now, we're pretty underweight. The mega cap companies. We've probably got about as low a weight, although we're an all cap American fund. We've probably got about as low a weight as we've ever had in those mega cap companies. And notwithstanding that, the fund still continues to perform, quite well, because also it's not about what sometimes it's also just about what you own and not sort of what the index is doing. As long as you've got other companies that are performing well, you can still produce a good compound rate of return.
Yeah, my sense, maybe this has changed, but my sense at least a few weeks ago was that you owned Microsoft, NVIDIA, and Alphabet, all of which you'd owned for quite a while. So I guess 3 of those 8 mega cap companies that have market caps of 100 billion or more. But the others like Meta, Netflix, Tesla, Amazon, Apple, not so much. Is that fair to say that?
That's right. We have 3. Our last filing we had 3 companies which made up, call it approximately 10% of the fund. And if you look at those mega cap companies, which have been driving the market this year and for a number of years, I think the last decade, 8 companies represented 60% of the performance of the S&P. Those represent 25 to 30% of the index, and we're around 10. So we have a much broader, diversified portfolio than index, which looks a little bit narrow today.
And it seems like you've been very consciously shifting back towards an emphasis on mid caps. In its original iteration, the fund was very much a small cap fund, and then a little bit mid caps, and then gradually became an all cap fund. And now it seems that it's shifting back towards a pretty heavy emphasis on mid caps. Is that partly a reflection of the fact that, as you call them, the mega cap 8 have gone kind of crazy over the last 10, 12 years, and that the valuations are just not that attractive? What's the problem with the mega caps, and what's the comparative attraction of the mid caps?
I just wanted to jump in here and tell you about this new valuable resource that we created for you. The biggest challenge to taking control of your personal finances, improving your investment returns, and building a better future is just getting started. This means getting organized, having a plan, and being disciplined. As Mark Twain once said, the secret to getting ahead is getting started. If you're not satisfied with where you're at financially, whether that be not having enough savings at the end of each month, watching your cash being eroded away by inflation, or maybe you're not sure where to get started with investing, down in the description below, we put together a free guide for you called The 4 Simple Steps to Take Control of Your Personal Finances and Life. You can get this free guide by clicking the link in the description below.
Yeah, so the challenge with the mega caps is that in the last decade or so, they pretty much had the sort of rails to themselves, whether it's Google in search or, Microsoft in cloud. Amazon in cloud, or Microsoft in, office productivity, and so on. If you look today, there's just a lot more competition. There's going to be more. There's more overlap. Google and Amazon and Microsoft are all competing in cloud. It's a more competitive area. Social media, Facebook has got more challenges there. TikTok, and there's just more competition between those companies. they're not going to be allowed to acquire companies in the way they have in the past. They've compounded revenues at sort of 25% roughly for the last decade or so, which is pretty extraordinary. But if the valuations moved up, if they're going to do that again over the next decade, they probably become a third of GDP. So I think it's just a sort of mathematical challenge. This is 1.5 trillion of collective revenue. It's just being scrutinized far greater extent from a regulatory perspective and from a competitive perspective. At Microsoft trying to buy Activision has been a real challenge. So that's sort of one angle. The second angle is we're actually really excited about mid caps as these large cap companies have dominated. We feel that the opportunity in mid caps on valuations, we're sort of going back to where we were in the sort of late 90s when we were much more focused on small cap companies. And I wouldn't say they've been ignored, but they've not performed, and so they've had a less attention on them. We are finding probably about 75% of the ideas that come into the fund over the last 18 months have been in this sort of $3 to $50 billion market cap range. And so today, probably 2/3 of the fund is under 100 billion, whereas 2/3 of the S&P is over 100 billion. And it's, we're evolving in that direction. There is another factor here, which really is around deglobalization and the advantage that maybe more domestic oriented companies are going to have as we move to a more deglobalized world. I mean, that's another conversation entirely. I'm happy to get into that, but we've got more of a domestic focus, companies that are going to benefit from US reshoring, nearshoring, and we're really excited about that opportunity.
Yeah, so these are companies that a lot of our listeners won't have heard about because maybe they're industrial companies or infrastructure services companies with a more domestic US bias. So I was looking at your portfolio, and there are things like Ferguson in heating and plumbing. These companies that not all of us have heard of. But then I was also struck that you were playing the AI boom in an interesting way. That although you own NVIDIA and Microsoft, which are both pretty big positions, and Alphabet, there's also a big emphasis on what you've called the picks and shovels providers of products and services that are going to benefit from IT spending on things like AI. Can you talk about things like Accenture or Gartner, these things that are maybe not as huge? They're not these mega cap companies, but they're very well positioned to take advantage perhaps of this AI boom, and they're not quite as pricey perhaps, I think, as some of these mega cap stocks.
Yeah, no, absolutely, love to. Maybe just stepping back a bit, we probably have 40% of the portfolio in what I would call sort of these picks and shovels type companies, which most people find a bit boring and not growthy enough, but we absolutely love. So whether it's, and what I mean by that is often they are providing, essential products and services that are a high value to the end, to the customer, but a very, very low percentage of their total costs. So if you take Sherwin-Williams, for example, in paint, actually paint as a percentage of the paint job is not a lot, but it's, having good quality paint is important. Martin Marietta in aggregates, the aggregates that go into, a new industrial gas facility or biotech plant, it's a pretty small percentage of the cost, but, it's sort of an oligopoly, and you've got to have the product, and you've got a bit of pricing power, and you need to have it when you need to have it. If you look at Texas Instruments or Analog Devices in analog semiconductors, they sell products for 50 cents or $1, but the content is maybe a few $100s that goes into a car. But they're critical products, but they're not. You're not betting on Tesla or BMW or GM or some Chinese EV company being the winner. You buy the picks and shovels company like Texas Instruments, and they provide analog semiconductors to all car manufacturers all over the world. And, whether it's the Chinese or the Indian or the Teslas or, the German companies, you don't actually have to be that smart and make a bet on who the winner is, because, if they need the product, they'll go to Texas Instruments. And we know the auto content in cars grows over time. So these are what I mean by, high value, low cost, but critical products. And it's the same in IT services. These are sort of picks and shovels providers, whether it's, in IT services, whether it's Accenture in consulting, or whether it's whether it's Gartner in providing, technology advice, or whether it's CDW in IT services. We just love these companies. Thermo Fisher, Danaher in healthcare. We have actually never invested at Findlay Park in a pharmaceutical or biotech company in our history. And you may say, well, Anthony, why not? The problem is we're not smart enough to know which products are going to get approved. And, what is the life cycle of that product? And when it comes off patent, do they have a product to replace it? If you're Thermo Fisher or Danaher and you're providing, the life science tools and consumables to scientists, and you're serving all the pharma companies, all the biotech companies, all the generic companies, all the Indian and Chinese companies, as long as you believe in science advancing, you're gonna generate more revenue every year, most years, and you can grow margins a bit, and you can generate free cash flow and reallocate that into more acquisitions or dividends or buybacks. And so these are, sorry, it's a slightly long-winded answer, but these are the types of businesses that help us manage downside risk. And to most people, they might be quite dull, but you're not going to lose a lot of money in them if you're wrong.
And I think I read somewhere in one of your reports that the valuations for these slightly less exotic kind of mid-cap companies are at basically 25-year lows compared to the valuations of the mega caps. Is that right, that there's a really big disparity that reminds us of, say, 1998, 1999?
Yeah, we have a chart in our slide deck which shows the relative valuation of mid caps. You can plot this against small caps as well, relative to the S&P 500, and which is obviously a larger cap biased index, and it is trading close to where it was in sort of late 1998, early 1999. So, and one of the things that we did is we're always trying to produce a good absolute compound rate of return for clients. And, small cap, mid caps got really rather picked over. A lot of the big fund houses, the well-known ones that you'll know, closed their doors in the 2000s to small and mid cap money, and they had too much money, and it had been a great area and in favor. S&P 500 companies were well out of favor. And that was the point at which we pivoted. And we said, well, actually, we need to look at all cap companies, because you can buy Microsoft on 12 times earnings, and you can buy, Walgreen on 11 times earnings, et cetera. And we can buy these high quality companies that have underperformed for a while. So we evolved. And now I think, Findlay Park 3.0, 25 years on, I'm calling it sort of back to the future. We're going back a little bit to our roots. Today, we look more like we did in those early days, with sort of mid-cap companies, $3 to $50 billion market cap companies being, 40+% of what we do, less than 100 billion, 60% plus of what we do. And it's really exciting, and we sort of stayed in the game in a way in the last decade. We hung in there in a period where, you had zero interest rates, free money, not the best environment in a way for Findlay Park, managing downside risk, low leverage. But now we're back at 5.5% interest rates. There's a real cost to money. We're in a new era. It's really exciting. And I think going back to our roots a bit with these slightly undercovered, unloved companies is going to be fantastic.
It's also interesting that probably one of the most important decisions you guys made from the very start that determined the success of Findlay Park was that you made the choice to focus on one country, that you picked America very early on, thanks to the good fortune of James and Charlie being experts on U.S. stocks. You have an unusual perspective on the U.S. because you live in the UK. You spent 5 years early on in your career as a European stock analyst, I think, but you spent over 20 years analyzing U.S. stocks. So you're detached an objective about the US, but at the same time, very knowledgeable and very immersed in it. And I feel like people routinely underestimate the dynamism of the US, and they look at all these problems and they always say, oh, America's finished, and look at this country that's going to take over. And then whether it's Japan decades ago or then China in more recent years, these countries that everyone says, oh, this is going to take over and the US is finished, the predictions of the US's demise always seem to be somewhat premature. And I wondered if you could talk about why the US simply is a very attractive place to invest, not just now, but as just it's just such a sweet spot to be an investor.
Yeah, it's so true. I mean, I spent the first part of my career, I say, working with James Findlay on the American desk, and I thought that's a great place to learn. But actually, ultimately, I live in the UK, and I should probably cover UK and European companies. So I decided to make that switch. And after 5 years, went back to working with James again. And one of the lessons was there's just simply not the depth of companies, of quality companies that you have in the US. And where you do have a quality company, there's 35 sell-side analysts, and they're picked over, and they're probably actually quite highly rated because there's so few choices of high quality businesses. They're trading on quite high multiples. And, America has just got hundreds, thousands of companies that can't possibly be, fully analyzed by everyone. And just extraordinary companies and businesses. I mean, thinking about the American advantages, obviously you've got, a capital market that's very, very liquid, that works. You've got 300 million, consumers against which to sort of leverage your business model. You've got a culture of, of business-friendly regulation. You've got, rule of law, an entrepreneurial spirit. And frankly, just a history of America creating new companies. I mean, just look at the S&P today. And when we talk about, look at those top holdings. I mean, you talk about NVIDIA today. Everyone's talking about NVIDIA at the moment, trillion market cap. I mean, where was NVIDIA, 25 years ago? Probably wasn't even invented. America has the ability to just innovate, bring these companies, whether it's Tesla or Netflix or Microsoft or Apple at some stage. And you look at Europe, look at the UK. Where are the new companies in the UK? Maybe we had ARM for a while. That's been sold. And actually, I think it's going to be relisted in the United States. So there just isn't. You look at the UK. You've got some banks and some oil companies and some telecom companies. America is just such a dynamic environment, and I think you're right. It's consistently underestimated. When you read the UK press around America, it's always been negative. I mean, I'm naturally a slightly optimistic person, and I'm always quite optimistic about America and its dynamism, and the R&D that drives unparalleled levels of innovation and extraordinary companies and wealth.
Also, an incredible work ethic. I was saying to my wife yesterday, I think I finished work at about 11 something last night, and she finished work at like 10:30. And it's like, where else in the world are people just sort of routinely working that ridiculously hard at the end of summer when I don't know. And I sort of feel, I'm not saying that to be self-congratulatory. I just look around and I see the people I know working really hard here. And I've worked in England and I've worked in Hong Kong. In Hong Kong, I think they had a tremendous work ethic. But it just seems like there's a kind of a dynamism and an intensity and a productivity here, and also this tremendous flow of capital to good ideas.
Oh, I think you put it extremely well. It's the American dream. Even actually US college is interesting. My son's just started at US college, my eldest son, and we just sort of dropped him off there. I mean, most people in the UK start equivalent of US college, UK university here at the end of September, beginning of October. He started on August the 15th. I did tell him, you're not going to get nearly as much holiday studying in America. He's like, yeah, Dad, I know, but he's committed to that. But whether it's studying, whether it's people have 2-week holidays, I think in America, and here they expect 5 weeks, 4 or 5 weeks. So yeah, it's we've got a lot of national holidays. I think it's a cultural thing.
Do you feel, just looking at the UK, that it's lost the plot a little bit? I mean, with Brexit and the like, and with the disasters of all your old Etonian prime ministers who went to school with me, like David Cameron and Boris Johnson. Like, is there a sense that the UK has lost its mojo and is just not such a dynamic and important force economically, or does it feel like the prognosis for the country is still pretty good in terms of business and investing and the like?
I think we're in a tough spot, but I am hugely optimistic about this country, where I live and work, and the opportunities still in this country to succeed. And I think that the advantages in the UK are still significant. As much as it's easy to kind of moan and say, Brexit this or the current leadership, I'm still very optimistic about the UK's ability to sort of pull through this. I think there are a lot of parallels between the UK and the US. I think we've got to get the policy right. I think that's key. But I think we've still got a lot of advantages here.
I was slightly surprised when I was looking the other day at the returns since late 1997 of the FTSE 100, this big British index, versus the US market. And so this is a long period of time since 97. So 26 years, something like that. And the FTSE has averaged 3.7% a year, whereas the S&P, which hasn't been stunning, but has been okay, has been 8.3%. And so, I mean, just a very long period of pretty dismal returns. Like, why is that? Like, why has the UK, the country that I came from and that I sort of left initially when I was about 21, 22 to move to New York, why has it been so lackluster for the last quarter century?
Well, I think part of the explanation is what we were just talking about, America's ability to renew, reimagine, create new businesses. If you take those mega cap companies, if you take some of those new companies out of the index and you just were to measure GE and Exxon and some banks, you probably wouldn't have a dissimilar result. So I think it's America's ability to create companies, leverage that over, a large consumer base, and then, leverage those internationally. I think the UK is at a somewhat of a disadvantage there in terms of, the size and scale. You do get a lot of innovation and great companies, but they do get taken out. They disappear at 5 billion, 10 billion, 20 billion, or they relist in America. Ferguson's a great example. I mean, they reimagined their business to just a US business, and they relisted in the United States, actually being a very successful company. So, I think that's it really. It's America's ability to create new dynamic businesses. The UK, sort of, you look at the index, it's still composed of much the same sort of companies as 10, 20 years ago.
You mentioned briefly your son going off to American university. I think you just have the one child, if I remember rightly. And when we first scheduled a conversation a few months ago, just informally, you wrote to me at the last minute and you were like, my son is about to play his last soccer game at Harrow, and I want to go watch him play. Can we reschedule for later in the day? Which I loved as the parent of two children, although I never made it to very many of their games. And it just raises this question of how you've managed to balance this pretty intense job of leading a team of 13, 14, 15 investors, managing $10.5 billion, managing this very successful fund, and at the same time trying to have a family and some kind of life and some sort of hobbies. What have you figured out about how to manage your time and perform at a high level while also not burning out?
Yeah, no, it's a great question. My son would say that, Dad, I may have gone to that match, but Dad, do you know how many other mums and dads are at these matches? And and you turned out to X many. So I'm afraid I get I do feel rather guilty that I've done my best. You just try and do your best. I mean, I think one of the secrets for me is I don't sleep very much. And I since my 20s, I can get by on limited amount of sleep. And so somehow I can manage and balance my work, my sort of family time, and then the other things that I want to do for myself, whether it's exercise or sport or, hobbies. I think I've balanced that sort of reasonably well. But it's a challenge.
How little do you sleep?
Well, I probably sleep about 4 or 5 hours a night. In fact, I woke up this morning, and my wife wakes up about 7, and she woke up at 7 o'clock, and I was still in bed. And she looked at me and she went, "What's wrong? What's wrong? Are you okay?" It just reminded me that, in fact, when she wakes up, I'm never in bed because, I get up at like 5:30 or whatever. My brain is buzzing. I'm doing some exercise or I'm starting the day, and I do that 7 days a week. So I feel like actually I've got a good balance between, work, family, and play. But it's always a challenge.
It's interesting because I've written a bit about like health and the like, and so I got to interview all of these people like Matthew Walker, who wrote this book, Why We Sleep, and so it's really become like almost this religious orthodoxy that you have to sleep 7+ hours, maybe 8 hours, and that we just need it, and that you're basically like driving drunk if you're sleeping less, and that it causes all of these catastrophic effects on your health. And I've thought about it a lot, and I don't know. I think I only sleep about 6.5 hours on the whole, and earlier in my career, I think we'd all kind of glorified the idea of sleeping less. I remember hearing that, people like Margaret Thatcher slept 4 hours. And I remember an old boss of mine at Time Inc., who was in charge of like 150 magazines, was said to sleep 4 hours. And this was a sort of macho thing. And I remember then Matthew Walker saying to me, yeah, but people like Reagan and Thatcher, who slept very little, ended up with Alzheimer's. And so it's a really interesting thing. I don't know to what extent we're being kind of brainwashed into thinking this stuff is really bad for our health, and to what extent it's really true. But again, it feels like the pendulum has totally swung to the other side. And
I've read Matthew Walker, and I read that. Is it Why We Sleep? I read it a few years ago, and I thought it made a lot of sense, and it was a brilliant book. And I tried to give myself the opportunity. Part of it is giving yourself the opportunity. You need to give yourself the opportunity to steal. I gave myself the opportunity, but I just couldn't do it. And I had the Fitbits, and I was trying and managing and measuring my sleep. I just couldn't do it. And it just, I failed. I mean, I figure that I'll probably die a bit earlier than my wife, but the number of waking hours that I'm awake during my lifetime might actually be similar, even if she lives 10 years longer than me. So listen, we'll see. So
one of the things that Matthew doesn't, when I interviewed him, I think he's more open about this in private conversation than he is as a sort of public proselytizer. And I think he's a very important public proselytizer, and sleep's hugely important. But I think he's more open in private about the fact that we are very, very different. And one piece of advice he gave me that was helpful was, he said, see what happens at the weekend when you don't set your alarm. See what happens during the day when you don't set your alarm. See what time you wake up. And so I during COVID, I started to do that. I just wouldn't set my alarm ever. And I still wake up kind of around the same time, but I think I'm so screwed up by the fact that I basically subsist on about 300 cups of coffee a week. And so I think I'm just be the worst example on earth. But without wanting to be self-referential about this, like, there are other things in terms of productivity and handling stress and operating at a high level that you've just found very helpful for yourself?
I think I love what I do. People say cliche, Anthony, have you got any advice for young people? It's like, follow your passion, do what you do what you enjoy. But I think I've been very lucky. I I had no idea about this business. And I got a job in asset management at a time when no one knew what asset management was, or basically my friends didn't. They knew what investment banking was. And I didn't really know. And I sort of landed on my feet in a way in this amazing company that I could listen and learn from a lot of people. And James Findlay, this greatest mentor in my life. And I just love it. I love doing what I do. So that makes life, the last 30 years really great. I mean, you get paid to learn about the world and make a few bets and make a few mistakes and hopefully learn from those and get better. And it's just, I love what I do. So I think that's really, really important in the sort of mental well-being. I have an amazing wife who is, my rock. I mean, she's incredibly supportive. We've been together for since we were 20. And, if I ever have issues where I'm thinking about this issue I need to sort of, solve, or sometimes it's not someone at work you can talk to about it. I mean, I have my managing partner here, Simon, who we're open with, but, she's been incredibly helpful in helping me sort of solve problems and manage through the odd issue here or there, or, key turning points in, when decisions need to be made. I've got a very supportive, just got a very supportive family. I mean, she's also been incredibly supportive. So it's made it pretty easy. And I think somehow we've sort of found a way to have a good balance. And when she'd always say, Anthony, I'd like you to take a bit more holiday. Well, you'd like you to work a bit less hard. But look, this is the job I have, and I love it. And, it's a responsibility, and, that's so you take that seriously.
And now when you look back on your success over the last 30 years, obviously there's been a great deal of hard work and skill, and you had good principles and a good mentor and good temperament and the like. But I'm wondering how you feel luck has factored into it, because you did just land there in that training program, the graduate training program with this great investor, James Findlay. You had the luck of focusing on a good market with the US. I mean, it wouldn't have been so good if you'd spent the last 25 years focusing on FTSE 100 stocks. How do you apportion the degree of success that's come from luck and the degree that's come from skill, do you think?
I think it's a hell of a lot of luck. I mean, as you said, I didn't know anything about asset management. I sort of got put on the US desk, working with Andrew Barker, who was my boss at the time, and James Findlay, and seeing this kid who was 15 years older than me. I say kid, I was the kid, but he was a young guy in his sort of mid-30s, making his way, and we hit it off. We connected. We somehow connected, and I helped him, and he loved to talk through ideas, and I was there to sort of be a sounding board, and I was a sponge. I mean, I love to learn. I've always loved. I think maybe this is the area that isn't so much luck. You talk about curiosity. It's a theme that runs through. But I've always been curious about, learning. I'm sort of okay at a lot of things. I'm not actually very good at anything. But, whether it's sort of playing snooker or darts or skiing, or I've always wanted to try and master, or yoga, or now it's calisthenics I'm sort of learning. I've just I love to learn and challenge myself in new things. Then I think I have a temperament, which is, I don't necessarily love to follow the crowd. I love the road less traveled. My temperament is suited, James's philosophy of managing downside risk if you're wrong, rather than going for that kind of shiny object where you can make lots of money and make a quick buck. I love this idea of, getting wealthy slowly and for your clients, building wealth and doing it in a way that, I'm very comfortable making decisions that are not necessarily what other people are doing. I'm incredibly comfortable with that. And even in some of my hobbies, my collecting, I love collecting, and I'm zigging where I'm, zigging where others are zagging, or whatever the right phrase is. And then you look down the road and you just sort of project out, and somehow, the world comes towards you. And so there's a lot of luck, and there's a bit of skill, and there's a bit of temperament, and who knows, there's sort of a bit of all of that.
What are you collecting?
I mean, I've collected so many different things over the years, but when I had a bit less money, sort of catalogs and stamps, and and then as I've sort of, I've actually been collecting. And not a lot of people know this, but I've been collecting watches over the last 25 years. I got really into watch. I inherited a watch, and I thought, wow, what is this? And I went down a rabbit hole and found out what it was. And then from there, I sort of discovered this whole world. But the watches I've collected are completely off the beaten track. They're not. These are not Rolex watches or Patek Philippe watches, or the sort of. They're actually watches that are made by independent makers. So independent people who have mastered the skill of making a watch all by themselves. And there was a chap called George Daniels who I met in early on as I sort of went down this route. And I couldn't believe that he made, he could make a wristwatch every year, one wristwatch a year, or a pocket watch, all by himself. Every single part, from the dial to the case to the movement to the jewels, everything. It was just mind-boggling. And so I bought a few of his watches, which have turned out quite well. But again, it wasn't what people were doing at the time, and I think I've always been quite comfortable with that. And
there is a sort of parallel in the way that you invest and the way you collect watches.
It turns out there is, yeah.
It sounds like there's an emphasis on quality, emphasis on what endures, a willingness to go your own direction.
And the road less traveled, doing what other people don't, I thought, if I'm wrong, I'm going to have something that I really enjoy. I don't think I'm going to lose much money in if I do want to sell it. But if I'm right, there's sort of optionality down the road. Who knows? It wasn't actually, I think I had one eye on a return, but it was sort of probably driven by passion. And yeah, this idea of doing something different from others. And today his watches are in, demand the world over, and it's absolutely bonkers. But
there's also a combination of quality and value there, which is not dissimilar to what you're looking for with companies, that you're trying to get a lot of quality, but you're not paying, you don't want to overpay for something that's faddish and in vogue.
That's true. And actually, when you look at a lot of the, you look at many of these big brands, actually a lot of their cost is, there's cost that goes into the making of the product, but there's a lot of marketing. There's a lot of marketing to convince you, whether it's in magazines or whether it's in sporting events or promoting, famous people or, megastars in different sports, that you should, this is how, so I like the idea that you were not really paying for the marketing. You're just paying the artist for the product. And, you're getting something a bit different, and you're engaging with that artist while they make the product. And you have to have a lot of patience. Sometimes it might take 3 years, 4 years to get something at the end of it.
It's interesting. Also, it's sort of Findlay Park story as well, because you guys aren't big marketers. You're going under the radar. You've never really talked that much in public, and yet you've quietly and humbly gone about actually racking up really high quality returns. And so there's something quite English about it as well, like not that much fuss and self-aggrandizement, but quite a lot of quality.
Yeah, I mean, I think James and Charlie set the culture. They're sort of low-key people. Personally, I think you should have been, you should have been interviewing James and not me. I mean, he's far more interesting and a real legend in my view. But not well known, because he's just such a low key person that he doesn't, caught the limelight. He never really sort of did press interviews. We were sort of closed, and that's just the way he liked it. Didn't need a lot of the, acclaim that perhaps other investors like.
He also seems to have established a trend of the firm being quite charitable. Like I know that you have a couple $1 million or so a year as a firm to lots of different charities. And when I went to your event, you had charities like City Harvest there that a friend of mine used to run and that Nick Sleep's been very involved with. And it seems like that's also a very central part of this, that it's not it's not big on swagger, and there is something kind of charitable and decent about it. What do you think?
It's not something that we really talk much about. Again, it's sort of, we like to be sort of low key about these things. But James, myself, we both feel we've been incredibly fortunate. This country has given us, opportunity. We managed to, make good careers out of that. And there is a feeling that we both have of the need to give back, to give back. That we've got stakeholders here. Our most important stakeholder is our customer, who want to deliver great compound returns for a long period of time. But we want to look after employees, and we want to give back to society. And so we do give back, a not insubstantial amount of our profit to charity. And we have a social responsibility committee here, and we engage employees in charitable giving, and we give money, we give time. So we bring people through Findlay Park and see if we can help them, and we give our time. And charity is not just about giving money; it's also about giving time. And so, we do our bit.
Yeah, it's interesting, that aspect of moral seriousness about the company, which I think also, we talked about James saying to you, treat the customer fairly. I think it's also running through the ESG stuff. I was struck by the fact that you had outright bans basically on investing in certain types of company that were derived like more than 10% of their revenue from things like coal-fired power and coal mining, or from oil sands, or tobacco, or controversial weapons like cluster munitions and anti-personnel mines and the like. So there is a sort of moral aspect to it. And I was struck also, I mean, going back to the ESG thing, I was struck that I think in 2021, you said that you sold Nike due to human rights and geopolitical tensions. So there is a kind of moral aspect to this approach to investing.
Yeah, I mean, we're getting into sort of, dangerous ground here. I mean, the primary litmus test is our investment philosophy checklist. And the truth is that many of those companies that you mentioned do not score well on our investment philosophy checklist. And so, we tend to avoid them. I think you do get into dangerous ground sometimes when you try and put some kind of moral overlay onto your investing framework. And we try and be, pragmatic, which I think I mentioned. But when it comes to things like tobacco and coal and oil sands and so on, they're not great fits with what we're trying to do.
I think what's really interesting is the way that you put it in terms of this framework of what's sustainable. So it is a pragmatic thing. It's investing in business that are sustainable, and likewise when you're investing as a firm, looking to make money over decades. And so I like that there's a good argument that's not really idealistic and dogmatic, but that's actually practical. It's like, there are reasons to bet on companies that are helping their customers and that are making their customers' lives better, rather than on things that maybe are making society worse.
Well, I think that's absolutely right. I think responsibly managed companies behaving responsibly, is a great way to generate compound returns over time. I mean, ultimately, that's what we're trying to achieve. And we think responsibly managed companies are best place to do that. And we're looking for businesses where we have a high degree of inevitability in the long-term outcome. And, that's where we guided to by our checklist.
I wanted to ask you one last thing, Anthony, if I may, which is when we first met early, I think in 2023, it was through a relative of yours, Simon Kelton, who's an old and dear friend of mine from high school and then college. And one of the reasons you'd stumbled upon Simon and become close to him was because you and he had done all this genealogical research, tracking your family back, maybe even to like the 13th century or something. And I was wondering if you could just tell us a little about it, because it's such a strange story about what you discovered as I think you got this company Genealogica, among other things, and you started to really dig deep into your family history. What did you find out?
Yeah, so I mean, my parents, as they were both sort of immigrants. My mother was, came to the UK. My father was a descendant of immigrants who arrived into the UK, sometime earlier. And I mentioned I'm sort of curious and I like to sort of learn about a lot of things. And when I spoke to them, they never really completely answered questions about, I always felt that I never really got the full answer. And so after my father died in 2008, I said to my mother, look, I really want to find out, the truth. Because I think actually understanding where you've come from, in my view, and having done this, I believe this even more, understanding where you come from helps you understand yourself. And helping understand yourself is no bad thing in life. Some of these things are very, very deep rooted and go back a long way. And so I embarked on this journey as sort of, actually initially it was just sort of ancestry.com. And I discovered my cousin, Simon Kelton, who you've known for years, who'd also made a family tree on ancestry.com. And we sort of came together. And I didn't know Simon, although interestingly, his uncle was chairman of Findlay Park. How bizarre, a 4 or 5 person company. And it turned out that James Findlay had appointed Simon's uncle as chairman of Findlay Park and had hired me. I'm not quite sure about that. I used to go home and tell my wife, Robin, who sadly has passed away now, really reminds me of my father. And I used to say this for years, and sadly he died before I found out that he was my cousin, Simon's uncle. So yeah, it turned out actually we had an awful lot in common. And he's become obviously his family, but he's become a great friend. I'm godfather to his eldest daughter, and it's been a wonderful journey. And I found out a lot about myself, which has helped me. I think has helped me in life, and actually, perhaps even more so than that, brought family together in a way that if I say I've done nothing else in life, through this, I have brought family together, and it may actually be my greatest achievement. Wow. And that makes me feel good.
One thing I loved when Simon started to dig into the family history is that when we were at Oxford together, he was so posh and charming in a kind of classic old Etonian way, like very smooth, very charming. He at one point, he wrote a book called, I think, The Rich Bastard's Guide to Living in LA, right? So he was sort of the quintessential elegant, polished, urbane, upper-class Englishman. And then when he starts to dig into the family history, discovers that I think it maybe was his great-grandfather who had been this very, very posh-seeming English wasp, and then turns out to have been Jewish and to have concealed it. And I come from a similar Jewish background. And what I loved is that Simon was so pleased to discover this. Like, instead of this being a source of shame, as it would have been to some posh English families, he was so delighted to discover, that, as the poem says, we contain multitudes, that he contained multitudes. What do you think?
Absolutely. I felt exactly the same way as him. And of course, his family is my family. So we were both delighted. But, there are some people who, don't want to discover these things and would rather not. And it's a little bit awkward. So, but for Simon and I, we're absolutely delighted. And we want to learn about, where we've come from and our ancestors and the challenges they faced and how fortunate we are to be here as a result of all the things that they did for us.
It's lesson in a way, that sense of your good fortune that your family had gone through so much over the centuries, and you end up here in this incredibly privileged position.
Absolutely. I mean, I think that this country, whether it was my mother or father, or their ancestors, the UK gave them opportunity. And at some stage, I am incredibly grateful. So, I live in the UK, I pay my taxes, I don't do anything clever. And I like to give back to this country. And I'm still, as I said earlier, hugely optimistic about so many of the aspects of the UK to make this country so remarkable. Yeah.
The social mobility has been incredible. I talk about this a lot with my mother because my grandparents really were pretty poor and came from tough backgrounds. And my grandfather used to sleep in the kitchen of his apartment, his parents' apartment in Glasgow in Scotland, sharing it with his brother. And my grandfather became an eye surgeon and his brother became a brain surgeon. And then they sent my dad to Westminster and to Oxford, these very privileged schools. And then I went to Eton and Oxford. And the social mobility that's been possible in the UK, which really reminds me of the US, is such a stunning thing. And we've been such incredible beneficiaries of that, of the fact that both the UK and the US took in talented people, in my case, people who'd fled from Russia and Poland and Ukraine, and let them thrive and get ahead and give them good educations and healthcare and the like, and an opportunity. It's a very humbling and important thing to recognize. I think it's a mark of why the UK and the US have been so successful.
Yes, I agree, and I'm hugely grateful to this country, and my wife and I, in addition to the giving that we do at Findlay Park, we set up a charitable foundation about 15 years ago, and it is focused and always has been on reducing social inequality in the UK. It's not to say there aren't other hugely worthy, causes, but that's, you can't do everything. You can't be all things to all people, and focus is important. Focus at Findlay Park, and we've focused, and we, that's what we're trying to do in our small way, is to have an impact and give back, to the extent that we can, in the areas of education, training, and mental well-being through human intervention, from kind of cradle to grave. And so we currently support about 40 charities in the foundation, and it's all focused on improving social equality, social mobility in the UK.
That's a beautiful note on which to end. Anthony, it's been such a delight chatting with you. I'm really glad that Simon introduced us and that we've got to hang out several times in the last year. And I look forward to many more conversations with you in the years to come.
William, thank you so much.
I heard Mason say, "Why own your 40th best idea?" And I said, aha, that's some of the wisdom that I have been searching for. What is the point of owning your 40th best idea? Let's say it's an equally distributed 40 businesses in a portfolio. If you're lucky enough to have that business double in value, it will add exactly 2.5 percentage points to your portfolio. And I just have always felt comfortable owning 10 or 12 businesses that I thought I could know well enough to risk sizable amounts of investor capital and my own capital.